Welcome back to the Wall Street Podcast. Today we're doing a deep dive into a key piece of research from JP Morgan. It's their Hong Kong Equity Strategy 2H25 Outlook, navigating the path to further re-rating. Just a note, this report came out July 20th, but was corrected on July 21st, 2025. So we're looking at the very latest thinking. Essentially, it's an in-depth look at the Hong Kong equity market for the rest of this year. The core message, expect more re-rating potential. That's despite an expected near-term consolidation after a really strong first half. The report hits on macro trends, capital markets, valuation themes, the works. Our mission today for you is to cut through it all, extract the crucial insights fast, give you JP Morgan's outlook and key recommendations without the fluff. Let's unpack this.
Okay, so starting with the macro picture, JP Morgan sees Hong Kong's real GDP growing 2.8% this year, 2025. That's actually an upgrade from 2.5% in 2024. And the main driver they see, consumption.
Right. And are we seeing evidence of that already?
We are. Retail sales, for example, may saw positive year-on-year growth. And that's significant because it's the first time that's happened since February 2024.
That feels like a meaningful shift. Does JP Morgan's own internal indicator reflect this?
It does. Their Hong Kong quarterly market indicator, the QMI, actually moved from slowdown up to expansion back in June. So that really points towards a cyclical recovery taking hold.
And what's underpinning that QMI shift specifically?
Well, it's supported by a couple of things. Stabilizing residential housing prices, which is key, and also pretty robust capital markets activity.
Interesting. It seems like a broad-based improvement then, not just one single factor.
Exactly. It's the synchronicity.
Yeah.
Consumption ticking up, housing finding a floor, capital flowing. It suggests a healthier underlying pulse.
Now, the report isn't all positive, is it? It does mention the fiscal deficit as something to watch.
That's correct. They flag it as a risk, mainly tied to lower revenues from land sales.
How big a deal is that deficit in their view? Is it sort of a minor point, or could it actually derail things?
It seems positioned more as a risk to monitor, something on the radar, rather than an imminent threat. Reduced land sales revenue definitely impacts government finances. But the report implies the current momentum from consumption, capital markets, and maybe stabilizing property values is strong enough to outweigh it for now. More of a background factor than a primary driver, but worth watching long term.
Okay, so with that macro backdrop, how did the equity market actually do in the first half?
It did very well. The MXHK index delivered an 18% return in US dollar terms, and it outperformed the regional benchmark, MXASJ, by about 5%. So a really strong start to the year.
Which leads into JP Morgan's point about potential consolidation in the second half, maybe a pause after that run.
Precisely. They frame this expected consolidation, though, as a potential buying opportunity.
That's interesting because there are headwinds, right? Tariff uncertainty, questions around Fed rate cuts, why the confidence that weakness is viable.
I think the core conviction comes down to fundamentals and flows. They see the underlying positives like attractive valuations and strong capital market activity, especially southbound flows, as durable. So even if there's a near-term pullback, the argument is that the structural re-rating story isn't broken. It's a chance to get in or add before the next leg up, basically.
Let's dig into that capital market activity then. How significant was the resurgence in financing in the first half?
Really quite significant. IPO proceeds hit HK $107 billion. Equity placements reached HK $174 billion. And importantly, those are the highest figures we've seen since 2021. So it signals a real return of confidence and liquidity.
Wow, those are big numbers. The report also notes something interesting about performance post-deal, right? IPOs versus placements.
Yes, quite a divergence. The top 10 IPOs, on average, saw a 16.8% return in the 10 days after listing. Again, the best since 2021. But placements, the top 10 placements actually saw a consistent decline after the announcement, and that's apparently been a pattern since 2010.
What does that divergence tell us? Appetite for new stuff, but maybe less for existing companies raising cash.
That seems to be the interpretation. Strong demand for fresh stories, for growth potential via IPOs, particularly if priced well. The placement weakness might suggest investors are more cautious about secondary offerings, perhaps seeing them as dilutive or less compelling than brand new listings. It suggests a market that's differentiating quite sharply.
Okay, turning to earnings. The report highlights a turnaround in forward EPS for the MXHK.
A major turnaround. The 12-month forward EPS stopped declining back in September 2024, and year-to-date, Hong Kong is actually leading the APAC region in EPS upgrades.
And financials are a big part of that story.
Huge part. Financials make up 52% of the MXHK market cap, and they contributed a massive 15% EPS upgrade. That upgrade was large enough to offset drags from other sectors. It really speaks to the importance of the financial sector's health for the overall market.
Why is that specific boost from financials so critical? Does it just reflect capital market activity?
It reflects that, yes, but it's broader. It signals the whole financial ecosystem, banking, insurance, exchanges, is seeing improved profitability. Since financials are such a large weight, their health fundamentally lifts the entire market's earnings outlook and lends real credibility to the re-rating story. It's not just sentiment, it's bottom-line improvement.
And yet, despite this strong performance and earnings recovery, valuations still look reasonable.
More than reasonable, actually. MXHK is trading around 14 times forward earnings. That's half a standard deviation below its 10-year average of 16 times.
Half a standard deviation below the mean. For our listeners, what does that practically mean? Is it flashing by?
Practically, it means it's cheap relative to its own history. It suggests there's statistical room for the valuation multiple itself to expand back towards that average. It's not an automatic buy signal on its own, of course, but it's a strong indicator of value.
Right.
It points towards a potential mean reversion play over time. Plus, you get a higher dividend yield, 3.8% versus about 2.3% for MXCM. So it's the most discounted major market in APAC outside of ASEAN, and it pays you more to wait.
That yield difference leads us nicely into southbound flows. Mainland capital coming into Hong Kong, the numbers are huge.
Absolutely staggering. Year-to-date net inflows reached HK $778 billion. That's about US $100 billion. And get this, it accounted for 23% of Hong Kong's total equity turnover.
23%, wow. What's driving that wall of money?
Two main things. The hunt for yield, given the low-yield environment onshore in mainland China, and regulatory encouragement from Beijing for institutions to allocate more to equities, including Hong Kong equities.
And there's a specific change coming that could boost this further, the dual counter.
Yes, the upcoming inclusion of the HKD RMB dual counter into the Stock Connect program. The idea is it should reduce transaction costs for mainland investors buying HK shares. And this matters because right now, there's a big positioning gap.
What do you mean by positioning gap?
Well, southbound investors hold, on average, only 2.4% of the eligible MXHK constituents. That compares to an average holding of nearly 20%, 19.7% to be exact, across all stocks eligible for Southbound Connect.
So they're significantly underweight the main Hong Kong index components compared to other stocks they could be buying through the Connect.
Exactly. There's huge potential for them to increase their allocation just to the core HK stocks if things like the dual counter make it easier and cheaper. It suggests this flow has legs.
Okay, let's touch on HIBOR and the US dollar. They were tailwinds in the first half.
They were. Low Hong Kong interbank offered rate, HIBOR, and a weaker dollar index, DXY, both helped liquidity and sentiment. Now, JP Morgan expects HIBOR to rise a bit in the second half, maybe to 2.5% for the 3-month rate from around 2% now. And they see the DXY ending 2025 around 94.7, which is roughly 4% lower than current levels. Still weak, but maybe not falling as sharply.
The report mentions historical correlations, right? Big HIBOR drops, or DXY falls, correlating with strong MXHK gains.
It does. Historically, a significant drop in HIBOR, like more than 1.5%, has often preceded average gains of 14% for MXHK, and a DXY fall over 5% has correlated with 20% average gains.
So even if these tailwinds soften slightly, they're still expected to be generally supportive, not turning into headwinds.
That seems to be the view. The forecast levels for HIBOR and DXY, while maybe less dramatically helpful than in H1, are still consistent with a supportive environment for Hong Kong equities, historically speaking. It's more about the degree of support potentially lessening, not reversing.
All right, let's shift to the specific opportunities JP Morgan sees. Which sectors are they favoring?
They're overweight financials. No surprise there, given the capital market rebound, the strong IPO pipeline we discussed, those record southbound flows, and product innovation. They specifically call out AIA Group, expecting its new business value NBV to grow 17% year-on-year in FY25.
NBV, new business value. Can you quickly clarify what that measures for an insurer like AIA? Why is that 17% growth figure important?
Sure. NBV isn't just sales. It's basically the present value of expected future profits from new policies sold during the period. So 17% growth is really strong. It suggests AIA is not only selling more policies, but also that those policies are profitable. For a major component of the financial sector, that kind of growth outlook is a powerful underpinning for the overweight stance. It signals real underlying health.
Makes sense. What else is overweight?
Consumer discretionary. That's mainly linked to Macau. Gross gaming revenue, GGR, has been consistently beating expectations. That's led to earnings upgrades across the sector, and JP Morgan expects solid, high single-digit GGR growth to continue in the second half.
Okay. And property, I recall that was upgraded.
Yes, upgraded to neutral from underweight. This reflects signs the housing market might be bottoming out. You combine that with better retail sales, decent tourist numbers, and still relatively low HIBOR. It suggests the worst might be over for property stocks. Not a buy yet, but less negative.
And on the flip side, utilities remain underweight.
Correct. Even though southbound flows might like their yield, JP Morgan thinks they'll continue to lag. The reasoning is that in a cyclical recovery and re-rating environment, investors will likely favor sectors with more beta, more upside potential tied to economic growth than defensive utilities.
Got it. Now, beyond sectors, the report mentions specific themes. Stablecoin is one.
Yes, that's quite interesting. Hong Kong is expected to issue stablecoin licenses around August. JP Morgan sees this clarifying the winners in this space. They point to Futu and Zhongan as potential key beneficiaries. Zhongan, for instance, has a stake in RD Innotech and also operates ZA Bank, putting it in a good position.
Another theme is the Northern Metropolis. What's the story there?
This is a major long-term government strategic initiative. Big infrastructure spending planned to develop the northern part of Hong Kong, integrating it more with the Greater Bay Area. The government is talking about issuing HK 150 to 195 billion in bonds annually to fund it.
Huge sums. And beneficiaries.
Under their coverage, JP Morgan highlights Henderson Land, given its land bank in the area, and China State Construction International, or CSCI, as a major construction player likely to win contracts.
And finally, high yielders as a theme.
Right. This is driven by that mainland low-yield environment, pushing capital towards Hong Kong's higher dividend payers. They screened for local HK stocks market cap over $5 billion, decent trading volume, and a dividend yield over 5.5%. It's a direct play on those southbound flows seeking income.
Okay, great overview. Let's get into our deeper commentary now. First module. Given the cross-currents consolidation expected, but also tailwinds, how should we really interpret JP Morgan raising their targets and saying weakness is a buying opportunity? What's the core logic?
The core logic is that the foundations have strengthened significantly, justifying higher valuations. They didn't just nudge targets. They raised the base case for the MXHK at end 2025 from HK $11,600 to HK $13,000. Bull case up to HK $14,000, bear to HK $11,000. This confidence rests on a few pillars. 1. Supportive liquidity from the weak dollar and relatively low HIBOR. 2. Valuation mean reversion, moving back towards the historical average from the current discount. 3. Those robust capital market activities continuing. 4. Sustained southbound inflows meeting improving corporate earnings, those EPS upgrades we talked about. So the buying opportunity perspective comes from believing these are structural positives. Any near-term dip caused by, say, Fed uncertainty or tariff noise is seen as temporary volatility within a fundamentally improving picture. It's a chance to buy into strength, essentially.
Right, makes sense. Second module then, mainland capital. We know the flows are huge, the dual counter is coming. What are the full implications? Are there nuances or risks beyond just more money coming in?
The implications are profound because it makes mainland preferences increasingly central to Hong Kong market dynamics. That 23% turnover figure means mainland investors aren't just participants, they're market movers. Their hunt for yield is shaping demand, favoring certain sectors. The key nuance JP Morgan points out is that massive positioning gap, only 2.4% holdings in MSHK constituents versus nearly 20% in the overall southbound universe. It signals the potential inflow isn't exhausted. It might just be starting for the core index names. The dual counter aims to facilitate exactly that shift. Risks. Well, the obvious ones are a sharp reversal in mainland policy supporting these outflows, or a dramatic change in the onshore yield picture making HK less attractive. JP Morgan doesn't seem to see these as imminent, but it does mean the HK market is increasingly tied to mainland macro and policy decisions. The integration is deepening.
Okay, final module. Looking at the specific recommendations, financials, discretionary, property upgrade, themes like stablecoin, Northern Metropolis. How do these actionable ideas tie back to the broader re-rating story? What's the link for investors seeking specific plays?
They tie back directly by identifying the specific engines of growth within that broader re-rating. The overweights in financials and discretionary are bets on the core drivers, capital market recovery and consumption travel rebound, respectively. The property upgrade is a call on stabilization supporting the overall macro picture. The themes offer more targeted exposure. Stablecoin taps into HK's fintech ambitions and regulatory evolution.
JP Morgan highlights potential winners like Sutu and Zhongin in what will likely be a concentrated market. Northern Metropolis is a multi-year infrastructure play, with clear potential beneficiaries like Henderson Land and CSCI getting direct government spending tailwinds. Essentially, these sector and thematic picks are where JP Morgan sees the broad macro improvements, the capital flows, and the earnings upgrades translating most powerfully into specific company performance and potential alpha generation. They are the concrete expressions of the overall positive thesis.
Excellent synthesis. So the key takeaway from JP Morgan seems clear. Despite expecting some bumps, Hong Kong equities look set for more gains in the second half of 2025. The drivers are improving fundamentals, strong inflows, still attractive valuations, and specific sector and thematic bright spots.
That's the gist of it, and perhaps something for you to think about drawing on the report. Given that historical link between HIBOR, the dollar, and Hong Kong stock performance, and JP Morgan's forecast for these tailwinds to soften but remain supportive, how might the actual path of those factors, maybe a slightly faster HIBOR rise or a less weak dollar, really shape how deep and how long this anticipated re-rating actually lasts through the rest of the year?